Bank of Canada held rates last week, as everyone, I think, on the planet expected. I think if they had gone up or down, there would have been riots, because I think nobody was expecting anything to move. And it's such a weird. I mean, Dave, you could probably speak to this better than I can. It's because I know you've tracked this very closely. But as far as like the U.S. economics and so on, like they seem to be really, really impacting strongly our bond rates and therefore fixed rates. Funny enough, I actually heard on the radio this morning. I listened to the radio with the kids on the way into school on Mondays, which is kind of hilarious, like a throwback. But they were talking about home prices. The expectation is that they're going to go up now 4.5% in 2024. And they were all saying, oh, we just need rates to come down. And, obviously they're not, real estate experts, but it's just funny that that's kind of like the general public's opinion. It's like, oh, we just need rates to come down. And as we've said, fixed rates are down like almost 0.75 points from last year. Variable rates are the only things that might come down in June or July. And even that, like if they come down 0.25 point, it's not going to impact the market dramatically. So like people really, like we said, they should have been starting to buy in November up until now. But now is the time, like when that rate drops and the general populace now thinks, oh, now's the time to buy, it's going to be too late. Like the ship will have left the dock, so like prior to rates dropping, or the perception of rates dropping, is when prices are still going to be fairly consistent, stagnant, whatever you want to call, like a standard increase. When the perception is that rates have dropped and now is the time to buy, like that's when we're going to see the big jump in prices. So like it's going to be too late at that point, and I don't think people understand that.
I mean, I think they should just leave it till the end of the year at least. I mean, I just don't know why they would, like you said, it's not going to make that big of a difference. But regardless, to the general public, it'll just be this trigger that will put them in the market. And then people will start buying regardless of whether it affects a difference in the future or a difference today. And then prices go up. And then here we are again. And then there's a housing crisis, a worse one. And then the modular home prefab 3D home printing thing is going to come out tomorrow too. I can't wait to see that. Is the cost? I don't think it's going to be any cheaper. It's just going to be a smaller home built for you.
When 30% of the cost of building is permits and development fees and all that, I gather there is something coming to that effect as well. So again, tomorrow will be interesting. But yeah, I think to both your comments about the like rate drops and everything, I mean, certainly that's something that Tip Macklem with the Bank of Canada has been kind of talking about, is not moving too quickly, even though inflation is down and people are suffering. Companies aren't investing in their business because their cost of carrying debt is too high, and the general population, their cost of carrying debt is too high. But knowing that they have commented that we have a housing issue and that dropping rates is going to fuel that purchasing market, which kind of further, creates a bigger hole. But it's kind of weighing that, the existing population that has debt right now, businesses that are laying people off, unemployment rate up and not being able to invest or not be able to carry their debt, versus people that, are looking to buy but don't have that debt yet. And so how does that affect? So I think it's kind of certainly a difficult balance between the two, to your point. I mean, really the population is just waiting for that positive headline of rates going down. But if rates go down even 0.25 point on a fixed rate from where they are right now, 4.99 for an insured mortgage to 4.75, is that like, if people hear that, is that really going to fuel you? If that's what you're waiting for, jump in. Like, do you not think that others will as well? Why not just get a now hedge, like on a shorter term, and then, when rates have come down over the next year and two anyways to a more stabilized number, you're just going to be renewing at that lower rate then. But if your budget can handle it, like we've always said, but Bank of Canada is going to drop by 0.25 point. So it goes from 6.2 to 5.95 on an insured variable rate.
It just
kills me that you can get a fixed mortgage right now at 4.99, like,
which is
insured.
Great.
So
which is great.
Yeah, which is excellent. And also we're still qualifying them at that rate plus 2%. So even if the variable rate drops to 5.95, like we're still qualifying at 8%. Like it doesn't change much as far as the affordability. But the public sentiment is, the perception is going to be rates are now down. We should go out and buy. And then when they get into the process, they're already on the road. It's like, oh, oh, we can get a fixed rate and qualify for even more. Well, let's do that. So really, like, they could have done that now instead of 3 months from now. So a couple other. Sorry,
just
Greg,
one final point. One final point, Paul.
Of course.
Here's my point, Paul. If you could buy the same house last November for $550,000 at whatever the mortgage rate was at the time, and you can buy the same house in May for $650,000, like, where are you? Like, who's lost at that point, right?
Yeah, if you're
Like,
saving,
you're
saving
clearly
a
paying more monthly, regardless of if the rate dropped like a full point.
Mm-hmm.
You know what I mean? And that same house was available. There wasn't as many of them, but it was there. You just weren't watching it, and you were thinking that when the rates drop, there's going to be 20 of that home available, but the price is going to go up because there's going to be 50 of you trying to buy that same house.
Yeah, and if your house goes up 50,000, but you're saving a quarter point in interest, you're still probably net down 40,000 in the 5-year term. Like, you're still losing in the long run because
and
of
that quarter point's for like a couple of years. It's not like the US where you're locking in for 30 years, which obviously which changes things. Like, the US market is much different for how their mortgages are treated. For us, you're locking in for a few years, but
so
who knows?
Thanks for tuning in, everyone. We hope you enjoyed today's episode. Please remember to like, share, comment, and subscribe, because we'd really like that.